Welcome to this explainer. Today, we're putting on our detective hats to look at Atkore Inc. They're a major infrastructure manufacturer, and honestly, we've stumbled onto a financial reality here that is just plain confusing. On the surface, you get one story, but man, when you actually dig into the data, an entirely different narrative starts to emerge.
So here is the literal $124 million question we're going to answer today. How does a company that has growing revenue actually manage to lose $124 million in just 3 months, right? It really doesn't make sense. To find out, we have to look way past the flashy headlines and dig deep into their official SEC filings.
Section 1. The Wall Street Consensus. Let's start by looking at analyst expectations.
Notice the overarching sense of calm from the experts. According to data from Wall Street Zen, the consensus among 3 covering analysts is generally pretty positive. You've got one analyst making up about a third of the group saying strong buy, and the other 2 recommending a hold. But notice what's completely missing? 0 analysts are recommending to sell. Nobody is hitting the panic button.
They even have an average 1-year price target of $81.67. Given where the stock has been trading lately, this target suggests some really solid confidence in the company's baseline stability. Wall Street is effectively telling us, hey, Atkore is on relatively safe ground over the next 12 months.
But let's shift gears for a second because things get a bit more complicated. This optimism feels kind of strange when you put Atkore's forecast side by side with its peers. Atkore's forecast revenue growth sits at a rather modest 3.29%, but the electrical equipment industry average is absolutely booming at nearly 34%. So why is Atkore lagging so drastically behind the rest of the sector?
Which brings us to Section 2, the Q2 earnings shock.
If we pull up Atkore's official Form 10-Q, the quarterly report they're legally required to file with the SEC, we hit a massive contradiction that absolutely demands an explanation. This document is where companies literally cannot hide behind PR spin. It's just the raw, unfiltered numbers.
The crucial point lies right within their statements of operations. For the second quarter of 2026, Atkore's net sales actually increased to over $731 million, up from roughly $701 million the year prior. That means they're selling more goods. Yet somehow their net income plummeted from a $50 million loss to a staggering $124 million loss. The business is growing its top line, but it's just hemorrhaging money on the bottom line. What is going on?
Let's figure it out in Section 3, investigating the missing millions. Time for some forensic accounting.
By digging into the dense and honestly kind of boring footnotes of that 10-Q filing, we can finally identify the prime suspects. We found 3 major one-time financial events that completely skewed Atkore's bottom line. Now, to be clear, these aren't your everyday operational expenses. These are heavy, isolated financial blows.
Breaking down exactly what hit them, the biggest culprit by an absolute landslide is a $136.5 million litigation settlement expense. Just pause and think about that for a second. A single legal settlement wiping out more than 9 figures of capital. Following that, we see a $25.6 million loss on assets held for sale, and finally $11.5 million in asset impairments. When you add all these up, the mystery of the $124 million net loss is entirely solved. It's literally just the weight of these massive one-time hits.
And just to make sure we're all on the same page, let's clarify that last term, asset impairment. Basically, it simply means an asset on a company's books has permanently lost value. In Atkore's case, they took a specific $6.5 million hit writing down the goodwill associated with their high-density polyethylene, or HDPE business. Put simply, they realized the business just wasn't worth the, let's call it good vibes, they originally priced it at on paper, and they had to adjust the ledger to match reality.
But why are they taking these hits right now? That leads us to Section 4, restructuring and divestitures. It's all about trimming the fat.
Tracing their timeline, Atkore has actually been aggressively shedding non-core weight over the last year. In February 2025, they sold off Northwest Polymers. Then in December, they dumped Tektron Tube. By the first quarter of 2026, they had completely exited their operations in Russia. And finally, in April 2026, they offloaded that HDP pipe business we were just talking about. They are purposefully shrinking their footprint to focus entirely on what they do best.
And it isn't just about selling off whole businesses either. It's about tightening up the operations that remain. Headcount reductions and plant closures are actively underway right now.
In fact, the SEC filing notes roughly $2 million in restructuring accruals that they expect to utilize within the next 12 months for things like severance. Now, while this restructuring definitely comes with immediate painful costs, think accelerated depreciation on closing plants and employee payouts, it theoretically leaves a leaner, much more focused core business behind when all is said and done.
Section 5. Solar Tax Credit Boosts. We actually found a really surprising silver lining here.
Here's how this clever strategy works. Step 1. Atkore manufactures metal framing and components that are used in the solar industry. Step 2. By doing this, they generate highly valuable, transferable tax credits under the Inflation Reduction Act. And Step 3. Instead of just hoarding them, they actually transfer a portion of these credits to their customers as a rebate. It acts as an incredible incentive for buyers to choose Atkore over their competitors.
And the impact of this strategy? It's huge. Over a span of just 6 months, this solar tax credit mechanism generated an incredible $33.9 million benefit that directly reduced Atkore's cost of sales. So you see, while the company is taking these heavy hits in the boardroom with lawsuits and divestitures, they are quietly finding highly innovative ways to boost their margins right out there on the factory floor.
Moving on to Section 6. Reevaluating the forecast.
Remember earlier how we thought it was super weird that analysts were optimistic despite a massive current loss? Well, let's trace their earnings per share, or EPS, trajectory. Right now, Atkore is sitting at a negative $3.58 per share. But Wall Street predicts it'll bounce back to a positive $5.46 by the end of 2026, and all the way up to $6.21 by 2027. Suddenly, this whole thing makes perfect sense. Those 9-figure legal settlements and the multi-million-dollar divestiture losses, they're one-time events. They're not going to repeat next year. The idea is that once the dust settles on all this restructuring, the leaner, meaner Atkore is expected to become highly profitable once again.
So armed with the actual truth hidden behind their SEC filings, the one-time legal hits, the strategic shrinking, and those clever tax credits, you have to ask yourself a critical question. Is Atkore a hidden gem, a fundamentally sound company just temporarily weighed down by a totally necessary restructuring phase? Or, considering they are still lagging behind their peers in revenue growth, are they a risky bet in an otherwise booming electrical sector? The underlying financials are clear. But the final verdict? Well, that's up to you. Thanks for joining me on this explainer, and remember, always keep questioning the numbers.